in silver, in my view, is going to be hundreds of percent gain. I think we're going to 300 to 500. They could get, because they've done that in the past. Whenever the stock market has peaked, 2000 top, 2007 top, the Fed cut rates aggressively as that market topped or shortly after the top, all the way down in the bear market. The news got worse and worse. They had motivation, mandate to act, and they did. But it didn't help the stock markets. They still collapsed. Even though they cut rates starting in January of 2001, twice that month, shortly after the high occurred in the summer of 2000, dot-com high. Twice they cut rates in January 2001. They cut rates all the way down, and yet the NASDAQ 100 collapsed 85% in 2 years. S&P 50%, even though they cut rates. Same in the mortgage crisis, 2007 to 9. Huge drop in the stock market, ongoing rate cuts all the way down, including QEs, which they instituted after the bad October in 2008, a year off the high in the stock market. You had a very bad month, finally. Bernanke's, he went to the Japanese playbook, QE, he engaged it. What happened to the stock market? It continued down for about 2 more quarters into March of 2009. What happened to gold then? Vertically, right back to the high almost immediately, and onward and upward it doubled in price because it was below 1,000, it went to almost 2,000 by 2011. So yes, they'll print money, but it doesn't usually go where they want it to go at those crucial times. Now, is it theoretically possible we could have a Weimar Republic where everything goes up? Well, in which case, okay, let's live with that notion. Hyperinflation. Price of bread goes up, doubles every week. Stock market goes up. Does it mean anything? Or are you merely keeping up with the degradation in the money unit? Well, so far since 2000, 26 years later, the S&P has only kept up with the decay in the money unit, meaning in real buying power. If you sold your S&P position in 2000 and bought a car, that same car now, or 2, 3, whatever amount, would be the same purchase quantity this time at a much higher price, simply reflecting the money degradation. Gold, on the other hand, is vastly higher in a percent basis than the money growth since 2000. The question is, could we go vertical and have a Venezuelan stock market? We showed a Venezuelan chart about 6-9 months ago. And if you saw it then, it was absolutely upward curving. It just looked beautiful. And you'd say, gee, I should be in the Venezuelan stock market. It was simply a reflection of money degradation. It was meaningless. Now we could become a junior Weimar Republic, so could Japan. But the technicals that we look at on the stock market and the Nikkei and so forth don't look like that's going to be the outcome. It looks like they're going to fail and actually go down in price. If we saw the technicals that said, no, they're going to actually be helped by the money growth because the technicals look okay, we'd say, okay, well, maybe we'll have a junior Weimar Republic. But still, the prime beneficiary is going to be gold. We've run studies of gold versus the S&P, relative performance, going back a decade plus. And it broke out late last year. Gold did, in a profound way, very clear. Silver exploded out of a base relative to the stock market. So when you look at different assets and say, well, if they're going to print money, everything's going up, but I want to be in the thing that goes up more, that really does gain in real value. And right now the answer to that is monetary metals and the miners related to the monetary metals, period.
Yeah, and of course, if you look at, for example, the price of gold during the Weimar Republic hyperinflation, there were daily swings of 30, 40, 50%, both up and down. So, even then holding a hard assets is a tough period. So if this scenario with equities were to play out as you think it would it make sense to then short equities at the top, or is that too risky of a play?
Silver's engaged already. If you plotted the chart each month, if you took ounce of silver divided into an ounce of gold, a lot of people do the ratio, which is the other way. We do it simple, divide an ounce into an ounce, express it as a percent. You can go back to 1980 and you'll see it was 6.5. And it wasn't there briefly, it was there for a while. And then in 2011, it was at 3.1. And we've been stuck in this 1 to 1.5% range for almost a decade, meaning off the page cheap. If you simply look at the spread chart, how come silver's not valued to gold like it was, in the last 50 years? Silver price broke out of that range. Well, If you go back and look, there's a couple of examples we've shown in our reports, and look at copper and look what it did over the last 50 years or so. A base metal, it's not monetary, okay? It was stuck in a range between 50 cents and $1.50 for decades. 1970s, 1980s, 2000, and up through late 2005. Copper finally sort of punched up through the top of that boring range. And within several quarters, copper tripled and got up to well over $4 without a headline. And then, there was a big sell-off after that, but you lived in a new range that basically was triple the average price of that prior multi-decade range. If silver were to match that, we'd be like 300 to 500, okay? And then you can even look at a lead chart, okay? A very exciting metal, okay? For decades, it was stuck in a range just like copper. But a year and a half after copper did what it did, lead did the same thing on its own. It tripled plus in price after breaking out of this boring range price in several quarters, and then lived in a new reality. How come silver was stuck in that range? Gold wasn't, copper wasn't, lead wasn't, and yet silver was capped in a 50-year range? What's going on there? Well, we know there's arguments and evidence that it's been, institutions have tried to restrain it. The problem is when you try to do something like that, no matter how big you are, when reality takes over, it'll bury you. And when markets make mistakes, like, the dot-com top, let's say, NASDAQ 100 then, and go too far, even though the argument's valid for the bull move, and decide, oops, yeah, it's true, but I went too far, quite often it'll compensate the other way by going too far the other way. Well, silver's done the opposite. It's been too suppressed for too long, and therefore it's literally in a tantrum. And so don't be shocked if it simply copies what copper and lead did, or catches up to gold in valuation terms, which would put it in that range, and do so very quickly. Because this process began actually last November. So it's not like it just beginning now. And at that point, you get into late summer, and we've been several quarters after the spread broke out, silver versus gold. And I suspect that's about when you'll be seeing the kind of numbers I'm talking about.
$500 silver sounds like a headline from a tabloid. But here's what stopped me. The bond market's technical breakdown, as described, is a critical signal. The speaker's point about the Fed's actions in 2000 and 2007, where rate cuts and QE failed to prevent market collapses, is a powerful historical parallel. It suggests that the current bond market weakness, despite Fed intervention, is not a temporary blip, but a structural shift. The argument that gold and silver are not just safe havens, but the only assets that have truly preserved value against fiat currency degradation over decades is compelling. What's missing from this narrative, however, is a deeper dive into the specific catalysts for the speed of silver's potential rise. While the historical silver-gold ratio and copper lead analogies are strong, the transition from a 5-0-year range to a potential triple-digit move requires more than just technical breakout confirmation. The speaker mentions the wet bar of soap phenomenon for silver, implying a parabolic move. My question for you is, given the potential for such extreme volatility, how do you balance the pursuit of massive gains in silver and miners with the need for capital preservation in a potentially chaotic market environment? Tell me in the comments.